This week's Federal Reserve meeting in focus this morning. A rate increase could have broad implications for the market and consumers, especially if the market believes that the Fed will continue raising rates in 2016. Joining us right now is the chairman and CEO of First Third Federal Savings. Chairman is Marc Stefanski. Marc, good to see you. Thanks so much for joining us.
Good morning. Thank you.
We appreciate you joining us. Do you expect the Fed to raise rates next week?
Chances are pretty good.
Yeah. What kind of impact does that have, you think?
Well, I think on the mortgage market, not so much. Not so much. The mortgage markets for 30-year fixed-rate mortgages have been around 4% for the last 4 or 5 years, and it probably won't change all that much. It may have an impact on savings. The savings rates may go up a little bit, but it's hard to get excited about an investment in a federally insured institution that's only going to yield you a little less than 1% anyway.
Yeah, you're right. Tell us about Third Federal. What you're seeing in terms of deposits, what you're seeing in terms of what you can glean from the health of the consumer right now.
Sure. I think the consumer confidence still isn't there. In the old days, which wasn't too long ago, if you were interested in buying a house, you would just go out and buy it and then sell your old house. Now people are waiting before they buy that new house. They're selling their old house first, and that gums up the works. It doesn't work that well that way. On the savings side, it's just hard to get excited about investments at less than 1%.
Yeah. Tell us about the mortgage market right now. It's fairly healthy. What does that say about the consumer?
Well, it's fairly healthy depending on where you are. In and around Washington, D.C., Maryland, Virginia, it's very healthy. Atlanta is very healthy. Parts of California, New Jersey, New York. But when you get in the breadbasket of America, the mortgage business is a lot slower. Yeah. And in fact, Florida's doing very well, except it's foreign investors and people are paying cash. So the mortgage business is kind of slow there.
Why is it so slow? Is it that much harder to get a mortgage these days? Or is it just the economy is not all that great shakes?
Well, yeah, the answer to that is both, yes. For someone who owns their own business, it's very hard because the ability to repay, which is part of Dodd-Frank, makes it very, very difficult because they have to document every bit of income that you have. So that knocks out almost 10% of our business on a day-in and day-out basis. It's very, very hard to get those folks qualified, even with an 800 credit score or 50% down. They have to show the ability to repay, which is different than how we normally have done business in the past.
Marc, what do you watch closely on a daily basis? Like, what do you wake up and look at to try to manage through what's been volatile times for the markets, for the economy, for politics? I mean, what is the most important thing that you're watching today? Is it the election? Is it the move by the Federal Reserve next week? Is it the stock market?
Well, first of all, because of Dodd-Frank, I think most financial institutions are under a bit of duress. We're still trying to figure out what the rules of the game are, where the hot points are with the regulatory environment. So that's pretty much our challenge on a day-in and day-out basis. As far as the consumer is concerned, we've accepted the fact that consumer confidence just isn't where it really needs to be in terms of home buying. And so we've expanded our markets to try to find those markets throughout the country where it's a lot hotter.
I want to follow up on regulation, if I may, because we had John Stump in the studio earlier this week.
Yes.
And it's interesting because here's a guy who's running one of the largest banks, Wells Fargo.
Yes.
And he's got much a bigger burden of regulation because he's one of the largest 8 banks, and he's got all of these regulators. Is that a benefit for you? Because even though he's as large as he is, you know, you're basically trying to get the same dollar, the same depositor, the same customer. Yeah. And you don't have the same kinds of regulation, even though yours is also, obviously, I'm sure, burdensome, but because of your size versus his size.
Yeah, well, there's unintended consequences with Dodd-Frank. And it's a trickle-down effect. The big banks are certainly affected and are under more scrutiny, I think, because they're more diversified than our simple program that we have, taking savings from the community and lending it back out into the community. But the trickle-down effect is this, is that the regulatory environment is still really tough, and there's unintended consequences. And I think that a lot of the smaller banks, and you could consider us at $14 billion kind of smaller.
Well, relative to
right,
JPM, but not so small.
Well, sure. Yeah. But, you know, we're feeling the effects of that. I think that the regulators are still trying to figure out who's at risk and who's not in the economic environment.
So what's most onerous in the regulatory environment?
Well,
what rulemaking is most problematic?
I think that a lot of the rules still haven't been actually written yet, and we're still trying to figure out where the goalposts are so we can manage, you know, in that environment. It's still kind of tough. And what used to be important was safety and soundness, and that's still important. But now things like CRA and where you're lending and how you're lending are a big deal now too.
On the business side, the idea in the markets is that as the Fed starts to raise rates, your net interest margins will expand.
Yes.
How soon does that start to really happen? I mean, 25 basis points, I presume, isn't going to do that much.
You know, well, some of the movement will take place with the home equity lines of credit, for example. Those will move a lot quicker.
Okay.
So the effect of a mortgage business like ours for the general portfolio will be a little slower because most of those adjust on an annual basis. But the home equity lines of credit, you know, that's monthly. So.
Real quick question, Mark.
Sure.
If they do raise rates next week, the first quarter basis point, do you expect to see a flood of demand, home buying demand that's been on the sidelines that's going to say, oh, no, they're going to go up 75? You know, we're going to see multiple rate hikes, and they're going to jump in and buy?
It'd be a nice problem.
Let me get in now.
It'd be a nice problem to have, yeah.
Do you anticipate that?
But you don't see it happening.
I don't know. You know, the consumer has not acted as predicted.
Okay.
You know, everyone's saying consumer confidence is up.
Why do you think that is? We're all scratching our heads about that.
Well, I think everyone from my generation, which is pretty much the baby boomers, they got burned and they want to get more conservative because their 401ks really never recovered.
So they're saving money.
They're saving money, and we're still
Kids are out
seeing
of college. They can now save as opposed to spend.
Well, yeah, and the savings, their retirement isn't where it used to be.
Yeah.
And so what they want to do is pay down their debt as opposed to build up their debt. And so that's gumming up the works. And not too long ago, baby boomers bought us all out of the recession every single time.
Unbelievable. Real quick, Mark, I know that you just gave a $5 million gift in partnership with the Cleveland Clinic. You lost your wife, of course, to pancreatic cancer. You think we'll find a cure soon? What do you think in terms
Probably not. I think our best effort is to make sure that the people that are affected by cancer are more comfortable and they have a quality of life. And that's why we developed a foundation called Rhonda's Kiss, and we do these benefits. We did one in LA, we did one in Cleveland recently, and raised over $1 million. And we just want to make people comfortable with their families, and sometimes providing wigs for people that can't afford it, or transportation to the cancer treatment. Those are the people that really need a better, more improved quality of life.
I sure do. Mark, thank you.
Thank you. My
Good to
pleasure.
see you. Thanks so much for joining us, Marc
Sure
Stefanski there from Third Federal Savings, CEO and Chairman. Still to come.